Market news now. Asian markets built on the past week's gains today following another rally in New York as traders welcomed a below forecast U.S. inflation read that dampened expectations for a sharp lift in interest rates. News that U.S. President Donald Trump and North Korean leader Kim Jong-un had agreed to meet on June the 12th in Singapore. That's the first U.S.-North Korean summit in history, lifted optimism and fueled hopes for peace on the Korean peninsula. U.S. inflation data provided some relief to trading floors, which have fluctuated over recent months on worries that an improving U.S. economy and an expected surge in inflation will force the Federal Reserve to tighten monetary policy. Japanese markets benefited from improved sentiment. The benchmark Nikkei share average jumped 1.2%. Hong Kong rose for a fifth straight day. The Hang Seng Index rose 1.0%. Chinese stocks had their best week in 3 months. This due to a buildup of interest in Chinese blue-chip companies ahead of them being included in the MSCI's A-share index. However, on the day, the Shanghai Composite Index closed down 0.4%. Wall Street stocks jumped last night while Apple inched closer to a market cap of $1 trillion. Lower than expected U.S. inflation numbers also helped to put investors at ease that the U.S. Fed may be slower in raising rates. As it raises rates, it will have the effect of making it more expensive to invest and do business. The Dow Jones Industrial Average rose 0.8%. The S&P 500 gained 0.94%, while the Nasdaq Composite Index added 0.89%. For more on the markets, we cross to Nompumelelo Siziba. She is live and standing by at the Johannesburg Stock Exchange. Good afternoon, Nompumelelo. We've seen the rand crossing that 12 rand 30 to the dollar mark. What's leading to that?
Thanks very much, Nzinga. Well, you've touched on a lot of the issues, actually. So that U.S. inflation print that came out yesterday, it gave investors some confidence that inflation won't be raging and therefore interest rates won't be raging as fast as maybe people thought. There is a feeling in the market that the Fed Reserve will raise interest rates by 4 times this year. The Fed has said that they're only going to raise rates 3 times. So it may give people the feeling that actually they're going to stick to their word and raise rates just 3 times because of this lower inflation print. But it's just one inflation print. We have to see what happens next month. And if the inflation number is higher, it will change sentiment. So of course, markets are very fickle and they get excited about one number. So we need to see what happens, the series of events in terms of the inflation number, what actually happens over a period of time to get a clear picture of what the Fed's interest rate trajectory will look like. So that's what's feeding some enthusiasm. And with that, obviously, the excitement is good for equities. People then develop a risk-on mode, and then they invest in equities, buy up equities, and equities markets go up. So that's pretty much what's behind the rand strengthening, because the dollar has since weakened on the back of that information. In terms of what's happening on the all-share index at the moment, that's opened in positive territory, but has now since turned into negative. However, the mining stocks are doing really, really well. Yesterday, they didn't have a good day at all. Locally, of course, we had that really dire mining data with mining for March, for the with mining production for the month of March down 8.4%. So that was negative, but also international factors influence what happened with the mining stocks. Let's take a look at the indicators. All right, well, I'm joined by Warwick Lucas. He's from Galileo Capital. Thanks for joining us, as always, sir.
My pleasure.
Good stuff. So it's been a rather strange week. There've been a lot of things happening. US Treasuries at one point shot through 3%, but of course that has since come down on the back of that US inflation number. Mr. Trump pulling out of the Iran nuclear deal. Yet markets really didn't behave necessarily as we would have thought. You would have thought there would have been a massive sell-off, around jitters and so on. So what's your assessment of what's happened for the week?
Well, I think to some degree those jitters are really more coming through the bond market than equity markets. I think there is still some slack in economic growth, which will eventually get taken away as indeed oil prices do go higher, but that's not threatening them at this stage. I think the key thing there, though, is that the actual slope of that yield curve, i.e. the difference between 10-year bonds and 2-year bonds, is still steadily flattening. I mean, we've basically seen it in the last week. That's flattened another 10 basis points, which 0.1%, which doesn't sound like an awful lot, but in fact, in the world of low inflation bonds, it matters a very great deal. That inflation curve is definitely suggesting some potential trouble to come in about 18 months to 2 years.
Okay, so for the Koko at home who's watching and listening to you talking about the yield curve, what does that basically mean in terms of implications for South Africa?
Okay, so what it means is, okay, in terms of the definition, a 10-year US bond yields 3%, a 2-year bond yields 2.6%. And what has happened is that 2-year bond rate has been going up more than the 10-year in the last few weeks. The key point is that when it flattens like that, it's suggesting that there is a inferred slowdown coming in the economy, and it also raises some near-term inflation concerns.
Okay, all right. And obviously, if that is the case, then it means that the Fed itself may have to hold off raising interest rates because they might scupper the growth that's going on there.
Well, it's always a bit of a clutch and break for them. That's the concern. Is now the Fed, of course, looks at unemployment, and unemployment data is, if anything, more inclining to tell them to hike than otherwise. So the Fed is pretty much in a tight cleft stick at the moment. They've pretty much got a hike in the next year or so.
Because of time constraints, I want us to go straight to the manufacturing and mining data that came out yesterday. Mining contracted by 8.4% for the month of March on a year-on-year basis, and manufacturing contracted by 1.3% also on a year-on-year basis for the same month. Now, these are key sectors in the economy, and of course, it gives us some sense of what may happen in terms of Q1. Added to that, there's been this whole Ramaphoria, the euphoria over Mr. Ramaphosa and his presidency. It looks as though now reality is beginning to set in, and people are realizing that we can't just look to one person. We need to look to the economy and what's happening on the ground. Business confidence is also coming down. What are your thoughts?
Okay, so the first thing, particularly with the likes of mining data, is one has to be very careful with that data because it gets noisy, A, because of the currencies, B, because of underlying commodities, and then C, the actual production of those can bounce around quite substantially. I think what you're saying about Ramaphoria is certainly, it's quite important. I think that after the initial excitement, I think there's a realization that yes, there's a lot to be done here. When we look at the essence of the New Deal, and quoting from a paper put out by Goldman Sachs, the essential comment there is that it's not too dissimilar from effectively the old National Development Plan, NDP, as a baseline, and I think that's fair enough. At the end of the day, the political backing around Ramaphosa is going to pretty much be inclined towards that sort of baseline. So it's not enough that we are at least stopping from the naked criminality of the previous few years, but to simply stop doing the wrong thing is not enough. So let's give an example of that. Take SAA as to how that's run. I mean, we've got an airline there that's basically running with 900 people or staff per aeroplane, versus something like British Airways or Qantas, which runs on about 150 per aeroplane. So that's telling me that there's a serious productivity problem in those state-owned enterprises. And of course, I mean, SAA is not the biggest, but it's certainly one of the most disastrous. And it may very well be necessary to take some extremely stringent action at SAA to actually shake the rest of the SOEs up, because that's a mess we just cannot continue with.
Indeed. Well, unfortunately, we're running out of time, so we'll leave it there. But thank you so much for your time, as always, Mr. Warwick Lucas. He's the Chief Investment Officer at Galileo Capital.